Good evening, everyone. Welcome to today's live webinar on merger and acquisition, practical considerations from ideation to implementation. We are delighted to have you all with us for this focused session on the practical aspects. It is my pleasure to extend a warm welcome to our Chairman, Sir C. Babu Ibrahim, our Vice Chairperson, C. Preeti Savla, Central Council Member, C. Pankaj Shah, our eminent speaker, C. Abhintan Mehta, and moderator, C. Khyati Tapa. We are honored to have us with today. I now request our Chairman, Sir, to kindly address the participants and formally open this session. Thank you, sir.
I'm extremely delighted that large number of participants uh, across the country has joined for this webinar. At the outset, I should congratulate the co-chairperson of the corporate land Gola, my distinguished colleague in the Apex Council's webinar, and one of the young and kind enough to join us today, the moderator Mehta and the speaker.
I'm sorry, I think there is some network issues.
Shall I speak, Seema, now?
Yes, ma'am. I would request our Vice Chairperson to please speak. There's some network issues. Apologies for that.
Yeah, good evening, everyone, and welcome all of you.
Uh, Admitted, just take if they can confirm. I cannot see that. That's all.
Very respected Chairman of Corporate Law and Corporate Governance Committee, Sri Babu Abraham, sir. Very respected Central Council Member of ICI, Sri Pankaj Shah, sir. uh, my dear friend speaker, the Abhitan Mehta, and my dear friend moderator, the Khyati Thapa, and all distinguished, I can say, enthusiastic audience for today's webinar. I welcome all of you on behalf of ICAI and CLCGC. Friends at CLCGC, we are in direct connect with Ministry of Corporate Affairs as regards to whatever company, as regards to Companies Act or any clauses relating to that or any challenges or the whatever issues and the support system is there by Ministry of Corporate Affairs. As regards to compliance system, yeah, Chairman sir.
Yes, please continue.
Yes, Chairman sir is traveling in Vande Bharat train. So I think there is some network issue. But let me tell, as I said earlier, my very respected chairman, Babu sir, is a person who I can say direct connect with Ministry of Corporate Affairs and taken a lot of pain for bringing this MCA forms, the online filing forms, that is V3 system. Now the MCA is saying that they are bringing the new system for filing the forms because the members and the companies are facing issues. We have kept our helplines open to ensure that the members who are facing the issues can fill the Google form. We have taken a lot of webinars and ensuring that, and our three people from institute are also sitting over in ministry, ensuring that whatever challenges are coming to all the members for filing the forms are sorted out. As regards to other clauses, friends, all of us are aware that in Parliament's winter session, there is a proposal to amend this and bring this new Companies Act. The ministry has asked us on several sections to give our inputs, which we have formed a special um, uh, experts group taken up in the committee and the given the inputs to ministry. However, there are lot of other things which are there to bring it. As regards to this webinar, friends, let me tell of all of you with this topic, mergers and acquisitions, the practical considerations from beginning, from ideation, inception to implementation, is the topic suggested by CA Pankaj Shah, and we have recommended the faculty, his friend, his and mine also, dear friend Sia Vitan Bhai. And then we thought, let us have, and Babu sir, Babu sir is a person, sir, this is the thing we have to do, and he's a person who will say always, yes, go ahead. The exposure and the experience what Abhitan Bhai has in this, we can say young age is enormous. We all will agree that today's session will be very value added session. And after 2 hours, maybe this 2 hours or say 1.5 hours, after that we will have a round of question answers also, which the speaker has agreed to take up. And Pankaj Bhai, if he is remaining, he can also take up. Right. So, with these words, I welcome all of you to this session and my special appreciation to our chairman, sir, and entire council, Pankaj Bhai, council member, for coming over here, accepting our invitation to address all of us. Thank you very much. Over to Pankaj Bhai. I can say about Pankaj Bhai, he is a newly elected Central Council member. He is belonging from Indore. However, he has been very close to Mumbai as he has done his initial period of professional career beginning from Mumbai and now belongs to Indore. And he is also in examination committee and vice chairman of career counseling and government accounting committee and contributing a lot for corporate laws committee also. So I welcome you, Pankaj Bhai. Over to you. Thank you.
Thank you, Preeti Ben, for such a wonderful introduction. At the outset, I am thankful to you and Babu sir, the chairman of the Corporate Law and Corporate Governance Committee, which is really doing outstanding work from representation to government to conducting such beautiful sessions for the benefit of members. It is truly outstanding. And kudos to you, Preeti Ben, Babu sir. Today's topic, from ideation to implementation of mergers and acquisition, which is a niche area of practice. 360-degree view is being given by Abhitan Bhai, and no other better speaker can be there apart from Abhitan Bhai because he has seen practical issues, practical challenges. We have seen the times when all the mergers had to go and get the seal of High Court. From there, it went to NCLT, and now fast track mergers are also prevalent. So, this is a continuous developing field. And for all those members who are really interested in doing something new and better and enter into this niche area, today will be a good starter for them to learn. And more of such programs will be organized. I would not like to take much time from between members and Abhitan Bhai. Abhitan Bhai is truly a gem of the profession, and he'll shine like a star in the future of profession. So, thank you very much for this introduction. We all await to listen to you, Abhitan Bhai. Thank you.
Yeah.
Over to Seema ji.
Huh. Seema, I request Babu sir has missed something. So if you want to share something, Babu sir,
Sure. I
Babu
would
sir,
request Chairman sir.
yes sir.
I think go ahead because probably signal is varying and anyway I'm sure this will be a very useful session if companies want to scale up. This is one of the most important things. Probably one of the most welcome section step is introduction of section 233 for the small companies and others too. Go into the fast track mode without going to the NCLT. That is a one of the most step, and I think that is facilitating lot of mergers today. not start mergers and all the very best. And we are eager to hear from the speaker. Forward.
Thank you so much, sir. I would now hand over the session to CA Khyati Tapa and request her to give a brief introduction of our speaker, and then we begin with the session.
Thank you so much, Babu sir, Preeti ma'am, and Pankaj sir for your insightful words and for laying the foundation for today's deliberation. Moving forward, it's now time for the technical session, and it gives me great pleasure to introduce our eminent speaker for the day, CA Abhitan Mehta. Mr. Abhitan Mehta is a fellow chartered accountant and law graduate and currently heads the transaction advisory vertical at CBV and Associates LLP. His professional journey began with his articleship at PwC, followed by key roles at the renowned firm Pansi S. Mehta and Company and later at BDA LLP. Under the leadership of Sri Gautam Doshi, where he enhanced his expertise in complex corporate transactions. He has advised extensively on mergers and acquisitions, succession planning, corporate restructuring, international taxation, FEMA, corporate laws, and accounting. Recognized for his expertise, the ICAI nominated him as a special invitee to review the Income Tax Bill 2025 for the Lok Sabha, Niti Aayog, and CBDT. He also holds the distinction of being the youngest ever chairman of the Direct Tax Committee of the Chamber of Tax Consultants in its history of 100 years. So, without further delay, let's welcome Sir to take us through today's session. Over to you, Abhitan sir.
Thank you, Khyati. Thank you, Babu sir, Preeti ma'am, and Pankaj sir, for inviting me and giving me this opportunity to discuss M&A from a perspective of ideation to implementation. So when we were thinking about the topic, what came in is most of us would know there are opportunities to do mergers or mergers do happen, demergers happen, buyback or capital reduction and other forms of M&A do happen. But why does it happen? What are the objectives being achieved? Is the role of the CA to enlighten their clients that these objectives of ours can be achieved through some realignment, maybe realignment of businesses in different companies, maybe realignment of shareholding, maybe a realignment of your books itself could help you with the subject. So first phase, one would like to concentrate on what all people have been using. There would be a list which is even much wider. But right now I have put together a list of about 20-25 items on M&A, on why generally a M&A would happen. Yeah. Is the screen visible?
Yes, Abhitan.
Yeah. Okay. So we are aware of generally of the overview. For example, if you want to acquire a business, just as an example, what can you do? If the business is in a company, you can purchase the shares of the company. If you can merge that company. If there are multiple businesses, you may demerge the business. You can acquire the business through a slump sale. You can put in your money in the company and buy back or do a capital reduction of the existing, or the new one, which is the swap of shares, which is very prevalent in the startup space, that you take over 100% of the shares. In exchange, you don't give money, but you issue a percentage of your present holding company, say 5%, 10%, whatever is the relative valuation. You just do a swap of shares. So these are the principal reasons, ways through which one could do M&A transaction. What are the reasons actually behind this? is critical. What triggers? These are the solutions to a M&A. But why is M&A happening? Here we took an example that you want to buy a company. So if you want to buy a company or you want to buy a business, these are the ways you can look at. What are the reasons people looking at? So which is right now very prevalent is value unlocking or sum of parts. One of the public domain examples which is there is, for example, is Vedanta. Vedanta is doing a demerger into 4 listed companies because each has its own different risks and different set of investor possibly. So consolidated value, earlier the regime was, or the thought process was, everything into a single basket will give you a better value. In last 5 years, it has evolved more to have different businesses and different entities. So to have different businesses in different entities, one reason is value unlock. Second reason is if the next generation is coming in. One generation wants to handle one business, another family member wants to handle another business, and everyone wants their autonomy. So then you demerge the businesses for value unlocking or from succession planning perspective as well. Second is now we are seeing many real estate players are, just as an example, are also building say a hotel. Then an investor only wants to come in his hotel and doesn't want to come in the real estate business. So again there is a carve out necessary. How will you move the hotel outside the primary entity? So when you have again multiple businesses but you want investors to come in one single business of yours, then you need to carve out that business. Third is IPO readiness. That if you want to bring an IPO after 2 years, how should your operating company be? If your businesses are spread across multiple companies, then how will you consolidate that? If your business is in a single company, but say head office is owned by the promoters, so do you want that related party transaction to continue, or you want to have a company which doesn't have any related party transaction? Then when one goes further for IPO readiness, one sees that there are various assets in the company which are non-core assets. Basically your additional land parcels or treasury assets. What typically happens is in Indian promoter driven companies, the money is accumulated in the operating company. They don't declare dividends because it has a tax leakage. So investments are also done through the same company. Now, when you are going for listing, the additional investments don't fetch any value. They may be valued at in your books, say, are worth even 500 crores. When they value the company, they are only valuing the business. They'll say whether these assets are there or not there. I am following DCF method or comparable method. So therefore, treasury or additional assets don't get a penny's value though they are worth even 500 crores. So therefore, it becomes important to carve out. Fourth is if you want to create a separate vertical for growth, then you want to demerge. Fifth is, which is happening a lot in the professional space and even the CA space, is to carve out the regulatory businesses and the non-regulatory businesses in separate entities. We are constantly seeing that non-regulatory businesses are, say, going in a LLP or even a private company, and regulatory businesses are housed in a traditional partnership firm. So, carving out the regulatory risk has also become a thing. And one has, which has been very high octane thing, is the IBC acquisitions. IBC acquisitions have become such a consideration for tax and regulatory considerations that commercially, even if you decide you want to acquire, the nuances of tax on loan waiver or on assignments are so heavy that we have to handhold the client on how your waivers, how your pending litigation, how your pending refunds of those companies are to be aligned in the resolution plan. But IBC has been a reason for takeovers again, which is governed more by the IBC Act Insolvency Code rather than the company law. So these were few. Kathy, anything you want to?
No, sir, you can continue.
Okay. If any questions, we can take up simultaneously as well.
Sure, sir, I'll let you know.
So these were commercial drivers, which we saw the 6 examples. If we have to see what are the few examples on tax considerations why this is done. If you see the commercial examples, most of them are, other than IBC, are very much linked to internal restructuring. So whenever you are doing an internal restructuring, you don't want a tax outflow. You don't want a business going from one entity to another entity within the group to entail a tax outflow. So any internal restructuring, one always sees that it is tax neutral, so that internal restructuring doesn't create a hole in the pocket. Second, when you are doing an acquisition, you want to see that you get a cost step up and you are able to claim the maximum depreciation. If you are buying a business, say on a slum sale basis, you are paying 100 crores. You want that you get depreciation on 100 crores. Earlier, it was not such a big problem. Other than land, everything was depreciable asset and you used to get depreciation. So whatever tangible assets you used to recognize, the remaining balance was goodwill, and on goodwill you used to get 25% depreciation. But the recent amendment in income tax couple of years ago, now there is no depreciation on goodwill, whether it is arising on a merger or it is arising on a slum sale or a tax paid transaction, as we say. Therefore, it is has become very crucial to identify various intangibles which one can recognize and claim depreciation. In 32, we have brand, trademark, licenses are there. But now intangibles like customer list, distribution network, long-term contracts are also something people are looking at to identify them, value them so that they get a tax depreciation. Generally, within the group, this is like a must or a strong starter. That if you have a loss making company and you have a profit making company. So, though for a group you are not making profits, or say you have made a 50 rupee loss and you have made a 100 rupee profit in another company. So, you will pay tax on 100 rupees in the company. That loss would be carried forward for 8 years, and if it is depreciation, for no time limit is there. But as a group, you have really only earned 50 rupees. So you would always want that I pay tax on 50 rupees as the group. Therefore, what you do is you consolidate both the entities. Consolidation can happen that a profit making is merged into a loss making entity, or a loss making is merged into profit making. Number of factors to be considered: where are the licenses, which is the heavy entity, what is the stamp duty cost, what is your 72A compliance. So number of a profit making will merge into loss making, or loss making will merge into profit making. But certainly if the losses are significant, it is expected to incur more losses in the future, then you want that the entities are at least aggregated so that the group pays tax on the net income of the group. In our example, 50 rupees and not 100 rupees. IBC, we have briefly touched, the tax considerations are many. Another is stamp duty. For example, we are aware that if you are doing a conveyance, the rate of stamp duty for the state we know, it is say 5%, 6%, 7%. We know the effective stamp duty rate if we are doing a conveyance of property. But if the property is moving through M&A, there is a efficiency which has been built in. For example, if an immovable property, hypothetically say in Maharashtra, if you have a company which owns a immovable property of 10 crores, if you want to move it in a normal course, you'll pay say 5%, hypothetically, you'll pay 50 lakhs as stamp duty. But if I want to move that from company A to company B, where I have say similar shareholders, I can do a merger and issue token shares of say 20 lakh rupees. Then the stamp duty cost will come to 2 lakh rupees. So there are instances where in transactions, immovable also in movable transactions, that the stamp duty cost is reduced. For example, there is a UP High Court, Allahabad High Court's decision for UP Stamp Act that business undertaking is considered a movable property and not a immovable property. So will attract stamp duty or as a movable property, it may consist immovable property. So that would only be possible if you are doing a scheme broadly. You're doing it through a BTA may pose certain challenges. So there are ways or sometimes a scheme of merger or demerger would help in reducing the stamp duty. You always achieve the same end result for the transaction which the client would want, but in a more efficient manner. Sixth, what has picked up steam in last 3-4 years with also a recent decision of Bombay High Court being confirmed by Supreme Court, that when you are converting a firm or a sole proprietor into a company, there is no explanation to section 32 or 43 which is hit, and you should get a cost step up because you are corporatizing. You should get depreciation on fair value. The value of shares would also be fair value. So for example, if I want to sell my firm and if the buyer is agreeable to a corporate structure, then one has seen that a conversion of firm to company happens with certain modalities and the exit is made in a manner so that the effective tax reduces significantly. So these are some tax considerations which I thought of bringing out why M&A happens. Another set of considerations which are more linked to family office or succession planning is where you want to realign the shareholding. For example, traditionally the shareholding has been coming as it is, but you have a working partner. Now you want to give him certain percentage of shareholding. Or traditionally the firms are held by every family member. There is a division happening within the family. So the shareholding has to move. So whether you do through a family arrangement, you do through a capital reduction, you through a buyback, are the ways to realign shareholding so that the economic interest which is there actually or is agreed is captured in the shareholding pattern, which may traditionally not capture it or capture a realignment happening within the family as well. Second is exit to minorities. So many times post listing, what happens? Few shares are left here or there, and there is a small minority. Or in one of the cases recently, the shares were traded in the secondary market, in the not on the regulated market. They felt the price is going up very high, and the smaller investors are getting sort of defrauded. So they did a capital reduction scheme to give exit to minorities. We'll come to the benefit and the processes of why and which route is selected. But exit to minority, you'll select between say a 231 route, a capital reduction route or a buyback route. Another what has been happening a lot is merger of the holding company in the operating company. So what happens is if you have a holding company which holds the shares of the operating company. So if you are going to any investor is coming or you are doing IPO, then the money on sale of shares will come in the holding company and will not go to the promoters directly. So therefore, this is a reverse merger of the holding company happens. In the startup jargon, it is known as the reverse flip these days, which one of the example is Dream 11, which is there in public domain. So merger of holding company into operating company has been happening. A very remote word of caution here. A GAR notice has been issued in Dr. Reddy's case, which has been there in their public filings. Ajanta Pharma was one order which rejected merger of holding into operating, though the facts of Ajanta Pharma were bad, but otherwise, broadly, you will find at least 10 to 20 schemes annually where a holding company is merged into the operating company. In realignment of shareholding, we have discussed family arrangement as another mode or reason of doing. Then this is an interesting reason to give bonus preference shares or debentures to non-resident. So you can issue bonus equity through normal process. You don't need a NCLT scheme. But FEMA says that if you want to issue a bonus preference shares or debentures to non-resident, it can happen through a NCLT scheme. So we have Britannia and few others who have done this. So why do you do this? Because the promoters most of the time need an encashment, but they don't want to dilute their equity interest. And company doesn't have immediate cash flow to pay such heavy dividends. So they issue bonus preference shares or bonus debentures to all the shareholders, including promoters, and then the promoters will sell their piece and get liquidity immediately. Sixth is structure simplification. This is the overall consideration nowadays, that traditionally formation of companies and upkeep was very routine. But now with time passing, number of layers rule coming in, administrative cost going up, in most of the things, SPVs don't serve any real purpose unless it is a regulatory requirement. People are very conscious and are seeing that how can we reduce the number of entities we have. So even from pure administrative point of view, reducing the hassle and the cost of management, structure simplification or structure cleanup activities have been robustly taken over by groups. For example, we have one group which has 5 to 6 SEBI regulated entities. For each different activities, they have a separate registration, separate entity doing it, which is below the listed company. So now they have come up with the ask that let's see what all a single entity, what all licenses we can combine. We don't want to have 4 entities doing partial segments of work. If we can have a single entity to the extent SEBI permits, activities which should be done by a SPV, and there are few activities which you can do with along with other SEBI regulated activities. Some other considerations, some different points on why again M&A happens. One of the most interesting ones or interesting to our profession is accounting. How in the world one would say that how is M&A and accounting, how are they related? So now Ind AS is clear how you should account for, AS is clear, and the 230 schemes basically on merger demerger says your accounting has to be in compliance with accounting standards. Originally under Companies Act 1956, that was not the case. You could account for in a different manner than the accounting standard, and because it is a High Court approved order, that would take precedence over the accounting standards. Now that has been almost done away because of the explicit language in 230 that your auditor has to certify your accounting before the scheme is approved by NCLT. However, in IBC, there is no such requirement. So in IBC acquisitions and a merger or a demerger through IBC, people are still providing for accounting which is not in exact compliance with accounting standard or Ind AS, or there is a deviation. A complete disclosure is made, and how it is dealt, it is very much there. It is not something which is not disclosed appropriately, but you are able to account in a manner which is different from AS or Ind AS, the prescribed manner. Similarly, fast tracked, very technically, the certificate is not required, but practically, the RD would ask for a statutory auditor certificate. And even in your schemes, once your auditor gives a go ahead to the accounting, to the process, the way you want to account, even a subsequent change of auditor will not impact. Because what happens is scheme may take 8 to 10 months to approve and may be effective next year. And there may be a change of auditor by rotation as well. But the new auditor doesn't have the right to question once the scheme is approved by NCLT. There is proper guidance by the institute that once accounting is approved by NCLT, that has to be adopted. Parallel listed companies. So, like ITC demerged hotel, or he spoke about Vedanta. So, you are having through demerger of company or Piramal demerged Piramal Pharma, you are having series of listed companies. The classic is the Adani Group's 7 listed companies. Another route which is becoming prevalent is to buy small listed companies. You do the open offer process, you buy the promoter stake, and it is followed by switching your business into the listed company or a merger of your unlisted company into listed company. This is happening for some time. The experiences with the regulator are mixed. On the first step of you taking over the listed company, there is no problem. It is a process, SEBI approved process under takeover code through which you take over the listed company from the existing promoter shareholder. But if for the second leg, if you have to approach the regulator again, if you have to do, it doesn't happen through a slump sale, but has to happen through a merger or a demerger scheme, some resistance has been seen from the regulator that this is a backdoor listing which you are trying to achieve. Now, non-compliant merger and has becoming a point of discussion. Earlier, we always had mergers where the shareholders are issued shares of the amalgamated company. So if A is merging into B, the shareholders of A will get shares of B. Now people are looking at instead, so though you merge, you pay a cash consideration out. It may be a non-compliant merger, the shareholders will pay tax, but it would still be one level of tax to the shareholders and the consolidation would be achieved simultaneously. Otherwise, what would have happened? If I purchased the business from, say, company A, the money I would have acquired it on slump sale, money will go to company A. Again, if company A has to declare dividend, it would be a second line of tax which will have to be paid. Therefore, to avoid second line, the better way which one has been evaluating is to merge for a cash consideration to the shareholders. FEMA, we have discussed bonus preference shares, bonus debentures. Now we also have a cross-border merger regulation. So inbound and outbound, subject to compliance with the regulation, have now been permitted. Another is appointed date. If you want to do a agreement between two parties, it would generally be for today's date or a forward date. Backward date are rare and few. And how much validity a backward agreement would have from tax and both income tax and GST perspective becomes a gray area. Whereas if you are doing through a scheme, so even if I'm sitting in December, I can say that I have acquired this business from 1st April 25. I can go up to 1 year back without any questions being asked. So if I want to do a transaction which has been in discussions and for some reason we are unable to conclude, we are unable to document. Though many times it happens that okay, from 1st June, 1st July, the profit belongs to you. But the paperwork has spilled over in a manner that 4-5 months have passed and the business has continued as normal. Then what to do? A scheme gives you a foolproof validation that the transfer has happened on 1st July. So where you want to do a anti-date transaction because of reasons it couldn't be consummated before, then the statutory sanction really helps in such cases. So friends, here I have tried putting why you do or what are the advantages, or I would not say really advantages, but what are the different problem statements which are addressed by mergers and demergers or capital reduction. It is very important to understand that what we feel can be achieved versus what can be achieved, the canvases is very different. The limited objective of putting few instances and taking you through it is the canvas is very wide. And the principal benefit which one tries to achieve is the tax neutrality. The tax neutrality on an internal arrangement or a cost step up when you are buying some business. I'll take a classic example of a problem one has in buying and selling a company. Assuming that the company has a manufacturing unit in Maharashtra, just we are not concerned with the state, but it has a copper manufacturing unit in Maharashtra. Now you are ready to sell the business. The acquirer tells you that I would like to buy the business, I will not buy the company. Why will he say? Obviously, if the book value is say 20 crores, he's paying you 100 crores for it, he wants the cost of 100 crores. So, what would be the buyer's consultant advising him? That sir, we need to buy business, otherwise, if we buy the shares will come and sit in your books for 100 crores. You will not get depreciation or cost step up for that. So you please insist on getting the business and not the shares. What would be the seller's expert telling him? Sir, if you sell the business for 100 crores, the company will first pay capital gains tax, 20 crores is our cost, so 80 crores will pay 15% tax, which would be roughly 12 crores. Then when we declare dividend, you again will pay 36% tax. So the tax cost, sir, is roughly 45% to us. It is very inefficient. whatever, for instead of 100, if he gives us 90 also, it is better to sell the shares to him and not to sell the business, so that we directly pay capital gains tax at 15% and we are through with it. How do you navigate this? Objective is simple. The buyer wants a cost step up and the seller wants to sell the shares so that he pays capital gains tax. Two ways which one has been recently navigated. And why this problem was not there earlier, or was not there so heavily earlier, was because of the Smith Securities ruling. What the buyer's consultant would have told him is that, ठीक है sir, आप shares ले लो, then we will merge the company. और गुडविल पे तो डेप्रिसिएशन मिलता है, सो देर इज नो प्रॉब्लम, एंड मर्जर की गुडविल पे भी डेप्रिसिएशन मिलता है, इज नॉट अ प्रॉब्लम, यू विल गेट इट. नाउ दैट रूट हैज बीन फ्राउंड अपॉन. So people have further innovated. People have innovated that you buy shares, but you make it a non-compliant merger, so that your cost is, say, 100 crores you have bought shares hypothetically. When you merge, your cost and fair value is the same. So though it is a non-compliant merger, so you have to pay tax, but the tax is the zero. Or you do a liquidation of the company, assuming whatever is the retained earnings. Again, because of your higher cost, you can do it. Recently, it was innovated in a different way for a client, where he was not buying it in a company, but he was buying shares himself. So it came to, can I convert the company into LLP? We have that Domino's AAR that shareholders will have to pay tax. But I have just bought it for 100 crores and that's the fair value. So though even changing shares to interest in LLP, it is a taxable event. But 100 crores minus cost of 100 crores, the tax is zero. It is a very good case that the company doesn't have to pay any tax on conversion. Though it's a sub judice matter, but generally is a good case on the count. So these things, friends, make us think on ways efficiencies can be brought in to any M&A happening within the group, any realignment happening within the group, any non-routine transaction happening, how we can look at it. How we can look at if there are losses in group in one entities and there are profits in another. If there is an investor coming in, there are other efficiencies on slump sale and many others. If the investor is coming in, how will I carve out the business? How will I see to it that I get benefit of the highest price? How can I look at when I'm transferring the business? How can I look at bonus stripping, which is within the framework of 94, 97, 94 now? So too many various different considerations. One can go on and on the landscape it evolves around. I would like to touch upon one. Can we put in the chat boxes open, Khatima?
Yes, so the chat box is open to all.
So I would ask a very historical question. We are all permitted buyback under Section 68 of the Companies Act, which is the internal process of the company. No regulatory approvals broadly are required. Form filings are to be done. If I have a company where Mr. A owns 40%, B owns 60%, and the value of the company for simpliciter is 100 rupees. Now there is a fight between A and B. And Mr. A has agreed that I'll offer my shares for buyback, entire 40% shares for buyback for 20 rupees. If the participants will say whether that 25% threshold, which is there in section 68, can a company do buyback in 1 year, or it will have to split it to 2 years, or say go to NCLT? So can the buyback happen at one go or not? Yes or no?
The participants can reply to this question in the chat box.
So, friends, the general understanding of the subject has been that you cannot buy more than 25% of your shares. You can only buy 25% shares. If you read section 68 again, it only says that 25% of the net worth can be paid on buyback. It nowhere deals with what is the number of shares you can buy back. But because it was in 56 Act, it comes to us like that no, 25% in number is also a criteria in 68. And had been a matter of debate now for 7-8 years whether you can do a buyback. What is the reading? Couple of years ago, the law committee report itself on Companies Act have clarified that the restriction is on quantum and not on number of shares. So even if you are buying 40% shares of Mr. A, you can do a buyback by just paying him 20 rupees, because 20 rupees is less than 25% of the net worth. With this, I'll briefly touch upon the process which we have for NCLT. So if one would have to divide the sections, the primary section is 230 and 232, which deals with the merger process and process on restructuring with creditors. The one we are focusing today is merger and amalgamation. Then we have section 233, which deals with the fast track merger process. Both merger and demergers are allowed. So it is small companies, wholly owned, without NCLT route is the fast track process. And then we have section 234, which deals with the cross border M&A. All the processes. So how does, if you decide that you want to do a merger, how does it go? For that, first is ideation, what you want to do, that is what we have discussed. Then for filing to NCLT, there are certain statutory documents of yours like MOA, AO, etc. to be filed. Along with that, the key documents are that you need to draft a scheme. Scheme drafting, friends, has become almost like a standard template, because schemes of all the listed companies are available in public domain. So if the transaction doesn't have peculiarity of a non-routine structuring, scheme drafting is very standard, and enough documents are available in public domain. Along with the scheme, you need to give your financial statements, which depending on different practices are by different NCLTs. So you'll have to check your jurisdiction whether 3 months or up to 6 month old transaction is allowed. Financials are allowed. You need a valuation report to certify the swap ratio. So whenever you are issuing shares to the merged entity, you need to issue a valuation report. But in certain states, even in case of merger of a wholly owned subsidiary to the parent company, where no shares are issued, there was an insistence of a valuation report that this even a zero share issue valuation report has to be given. Then you need a accounting certificate from your auditor that the accounting treatment which is prescribed in the scheme is in compliance with the accounting standard. A list of creditors has to be given, and the crucial part is if you are able to give consent of creditors and shareholders. Okay, with more than 50, some are more than 70, some wants more than 90. But why is this important? Because once you give consent of creditors and shareholders, then there is no need to call for a meeting. Otherwise, a meeting of shareholders and creditors has to be called for, which itself as a process will, increase the timeline by 45 days. Therefore, if there are lesser creditors or it is possible to get consent of high value creditors and shareholders are in unlisted companies, one would invariably get for the majority of the shareholders their consent. So once you are ready with all this, you file the scheme. If you are a listed company, first the scheme has to go to SEBI for approval. SEBI would then ask for creditors' consent, will scrutinize the scheme, will, in addition to valuation report, will also want a fairness opinion from the merchant banker and take somewhere between 60 to 90 days to approve the scheme. Only after SEBI approval, you can file the scheme to NCLT. If you are a RBI regulated entity, say example NBFC, RBI also wants you to file the scheme in more or less all cases of change of control and other specified scenarios. But RBI and filing with NCLT can go parallel. It is RBI doesn't mandate that RBI approval is received before filing of scheme with NCLT. So from timeline perspective, point 3 and point 4 can go parallel, whereas point 2 on SEBI has to be first completed and only then point 4 can happen. NCLT first hearing order, all the time frame taken these days in Bombay at least is anywhere between 8 to 12 months. So the time frame is pretty high, and the time frame of 8 to 10 months is kicked in from NCLT filing. Preparatory steps is something in your hands. People are ready in 2 weeks, and some people are not ready after 2 months as well. So all depends on your readiness to the subject. Then what you generally ask for, the primary ask in the first NCLT hearing is a waiver of shareholders and creditors meeting. For example, both the companies have a very highly positive net worth and there is no adjustment to any creditors right, then one would ask for a creditors waiver, a creditors meeting waiver. Sometimes the NCLT will grant a full waiver. Sometimes they'll say you issue notice to all the creditors if they want to object. Sometimes they'll say you conduct a meeting at least for secured creditors. So it depends on your facts, on that NCLT members' comfort, but different outcomes are received in different scenarios, different members as well. So once you get the first NCLT order, it is broadly, and it is equivalent to like a admission order, but it is a application which has been disposed of, but one can say it is the petition is admitted in loose language. Then the entire activity starts. You have to issue an advertisement. You have to give notice to ROC, Registrar of Companies, RD, Regional Director, and Income Tax. Now, income tax also has become a must. Earlier, it was only when they used to direct. Now, as part of the law itself, notice to income tax has become a must. And if you have to conduct shareholders meeting, creditors meeting, you'll give that notice, 21-day clear notice. If only a notice of scheme is to be given, you'll give that. Then you would have to work along ROC, RD, and income tax to get their NOCs. Though the NOC in law is not mandatory, but practically, at least ROC and RD NOCs are must before the NCLT will approve the scheme. So then, once the notices are given, your shareholder notices also go used simultaneously, then again file to NCLT, which is known as the petition for final approval. And simultaneously provide them data, answer to their queries, and work with them to get their NOCs. Then it is the final NCLT hearing where any observations, generally you will have at least 4 or 5 observations from each authority, which you will have to give your rebuttal or amend the scheme or give undertakings of doing ABC. For example, income tax, it is very standard to say that income tax will have rights during the time of assessment. So you just give the undertaking, you agree to that. Once all the undertakings are in place, the rebuttals, NCLT is satisfied with it, NCLT will give the final order. And then the final order is filed with ROC to make it effective in the system. Other nuances are there on transfer of authorized capital, form filings, etc. We'll not get into that nitty-gritty. This is the broader process which one has to undertake. If it is a merger, along with ROC RD, you will also have the official liquidator, and in cases CA2 official liquidator. So you'll have to work along various agencies to get their NOCs. What is the broad objective? What do they broadly look at? They are not there to look at your commercial wisdom. They are not there to look at your share swap ratio. If it is a minority exit, their work is to look at, is there nothing against public policy? There is no wrongdoing, there is no, sham transactions or something out of the normal course, which is not for bona fide reasons, is being undertaken. So sometimes you'll also find that few schemes here and there, like Ajanta Pharma and couple of others, have been rejected being considered as tax planning devices. You will find that because of some pending investigation or things, the schemes are not allowed. So it is for NCLT's judgment call and each RDROC's judgment call that the scheme is not against public interest. They are not supposed to look at private interest. Like the shareholder should have got 10% more shares, that is not their prerogative. Their prerogative is also to see that there are no pending penalties, there are no pending violations, there is no compounding or anything which is left. So the objective is to see that on a holistic basis things are proper and are not against public policy anywhere. So this is a slight detailing of the same, that how the process goes and what all few forms which are to be filed. Friends, this is the one we discussed, is a very detailed one where NCLT gets involved. Now we have the option of fast track mergers and demergers, where NCLT is not involved. So your first paperwork is almost similar on drafting of scheme, valuation report, financials and everything. But the number of authorities you have to go to for approval is drastically reduced. So it would be RD and ROC broadly you will be concerned with. OL is also practically in very few and rare cases. Otherwise, it is only the RD ROC's office where you are concerned and you don't have to go to NCLT or as a process. So, which companies are allowed to do fast track merger was earlier very restrictive. It was only small companies and merger of a wholly owned subsidiary into the holding company, which was allowed to do under the fast track route. The definition of small companies earlier was 4 crore of capital and 40 crores of turnover. Recently, from 1st December 25, it has been revised to 10 crore of capital, so it should be less than 10 and 100 crore of turnover. So, the definition of small company has also been expanded. Last year, merger of foreign holding company into its Indian subsidiary was allowed, and we have couple of orders where reverse flip of a foreign holding company has been merged into a Indian boss. And September this year, the scope has been really expanded of fast track mergers. Now, if you see primarily startups are allowed, startup with small company is allowed. The biggest expansion is number 3. If it is an unlisted company with loans and debentures of less than 200 crores, so asset size, turnover, nothing is a cap. You should not have borrowings of more than 200 crores broadly. Then you are allowed to go under fast track. This is a big expansion, big ease. Also because NCLT are also looking at IBC cases, the time frame to approve company case mergers under company law has been increasing. And now with this relaxation, broadly except the companies involving listed companies or very heavy companies which are borrowing more than 200 crores would all go under fast track. If there are borrowings within the group, see if you can repay those or convert them into equity shares or preference shares or some way so that your borrowings reduce to less than 200 and you go under the fast track route. So, holding and a subsidiary. So, earlier it was only wholly owned subsidiary. Now, any holding subsidiary company you can merge. One subsidiary with another subsidiary of the same holding company you can do under fast track. And in both 4 and 5, the only exclusion are listed companies. So if you see broadly, a very wide gamut has now come under fast track mergers. There is one this has been a very positive development of this year to encourage fast track mergers. However, in the committee report on income tax bill and the Income Tax Act 2025, fast track demerger is outside tax exemption. So the exemption under 219AA has been restricted to demergers happening through NCLT and not under fast track. So it would be a significant deterrent unless changed and heavy representations being made that if you are easing the burden on NCLT, easing the ease of doing business in India, where RD ROC are already looking at the scheme, why not the same exemption being given to fast track? demerger. But as things stand today, fast track demerger is exposing to tax risks and has become a deterrent where unless it is a must on time frame that we need to achieve the restructuring in say 3 4 months and cannot wait for almost a year, only then demerger is something being evaluated, again depending on the level of commercial reasoning versus the tax exposure. A very cautious decision is being made. So very important to be aware of the change in the interpretation and language of 219 AA, that fast track demerger would not be covered. Earlier, the professionals were divided. Even earlier, there was a view that it is not covered. But now it has been clarified of sorts in the Income Tax Act 25 itself. One key additional requirement for fast track is the 90% approval of shareholders and creditors. This sometimes becomes such a teething challenge that shareholders, most of the time, you are getting it or not. But for creditors, it takes up couple of months for getting creditors' consent. And your financial statements, draft financial statement list of creditors, all have a cutoff. So it has happened that you have to restart the process because you didn't reach 90% in 2 months. Because, for example, I decide sitting in December that I'll take 15 November as cutoff. So that cutoff accounting is over by 15 December to arrive at a certified number. Now I get 85% by mid February, but some creditors is somehow not giving the sign off and gives the sign off in March. Then my list is old, which the RD will not accept. So I'll again have to restart the list, redo the list, and again go to all the people who have already given consent. So unless we are very sure of creditors' comfort and being able to achieve that in timelines, sometimes with surety also it doesn't work. In one case, the RD just said that this is a confirmation on email from a foreign creditor. I'm not happy with it. So, where number of practical things do come up, but that's a crucial decision making point too. Both whether you're able to get it and how comfortable you are. Otherwise, one can go under the NCLT route and possibly get waiver in the depending on the facts of the case. Or if you hold meeting, this again is not a problem that in any meeting it is only people who are coming and voting. So if only 10% show up and they vote in favor is fine. Whereas if you are going under the fast track route, you need a pre-clearance sort of a pre-approval of 90%. And the companies are supposed to be solvent. This problem comes in, structure simplification. When within the group, generally the companies are there and with token capital have been incurring basic losses and net worth is negative by few lakhs. You cannot go unless you make under fast track unless you make the net worth positive. Again, representations are being made that if the combined entity's net worth is positive, the fast track route should be allowed, but poses challenge in going the fast track route if the solvency is not there. Again, slight detailing. Only one thing, that if for any reason RD is rejecting your scheme, it is not a rejection, the scheme will be referred to NCLT. So you'll have to follow the NCLT process. It is not that you'll have to redo everything. Automatically, the same application will go to NCLT and NCLT will hear the matter. Another is the cross border mergers. So, this I have purposefully, I'm not getting into very detail, but cross-border mergers are permitted, it has to be in compliance with the FREMA cross-border regulations. What has been happening recently, or the common examples are any foreign subsidiaries which doesn't have any business operation now, or the business operation is hived off, is merged into the Indian parent, or host of startups which had a foreign holding company and are now looking for listing in India. The holding company are reverse merged in the Indian operating company. We have examples from Delaware, we have example from Singapore, Mauritius, where the companies have been the startup holding companies have been reverse merged or folded into the Indian operating company. Broadly works for foreign entities which do not have hard assets outside India. Otherwise, that would trigger a branch of the Indian company outside India. Secondly, for merger into India, the tax exemption is available. However, for merger from of an Indian company to foreign company, the tax exemption is not available. So such mergers are far and few. More where the Indian company is merging into the foreign holding company. Even those are very few examples. So we have touched upon the concept of appointed date as one of the considerations. I had mentioned that you can go back up to 1 year on the appointed date without there being a question on the subject, was because there is a MCA circular which was issued in 2001 year. Secondly, it gives you an option to select a forward appointed date. So if you want to link it to a telecom license or any approval being received, so you have an option to select even a forward appointed date for merger. So gives you a flexibility. Generally, appointed date one would prefer being 1st April or 31st March. And the concept of appointed date runs across all the types of M&A we are talking about, be it merger, demerger, fast track, or cross border. Importance of appointed date is also for income tax. That would be the date from which the income and expenses would be deemed to have been incurred by the merged entity. Whereas GST doesn't recognize the concept of appointed date. GST goes by the owner on the point of transaction and doesn't deem a backward date to be the date of GST liability as well. So, few decisions where a scheme has been questioned on tax perspective. Recently, in Maruti Suzuki's case, it was questioned whether you can merge two group companies where one has losses. The arguments were that section Income Tax Act itself has enough safeguards, so it is not appropriate for NCLT not to approve a scheme. The tax department can look at it at the time of uh, assessment. Similar view is given in hologram's case. So these are broadly a few tax rulings, sorry, NCLT rulings discussing on tax. Friends, now briefly, we have 5-7 minutes more, then we'll go to Q&A. Going to capital reduction. So why? It is if you want to do a forced buyout from shareholders. If you have a 15% shareholder in a company, you want him to exit, and he is not exit. So then you can do a capital reduction scheme. Second, if you have a negative retained earnings balance and you have securities premium or paid up share capital, and now you are earning profits. So your profits now are going to reduce your negative P&L balance. Then you cannot declare dividend. In a capital reduction scheme, you can knock off your securities premium against the negative balance so that your profits going forward, you can declare dividend. Also, a negative P&L balance looks bad optically. Whenever you approach for any fundraising to any lenders, or so again, knocking off against securities premium helps you from optical perspective. If you want to convert equity into preference or equity into loan, that also is possible and can be done through a capital reduction scheme. If you have issued preference shares, say of 75 crores, and your accumulated profits is only 20 crores, now the time is for redemption. Section 55 says you can redeem only out of profits or fresh issue of shares. So how to do? You have money, you have cash there with you. There is no loss incurred, but you have not made sufficient profits to redeem. So again, you can, in such scenario, redeem preference shares through a capital reduction scheme. If there is a family arrangement there, where shares are not supposed to move, because say for FEMA reasons you are unable to move the shares. You cannot give a gift to non-resident, though there is a family arrangement. And it works if the shares are cancelled for nil consideration. Then also it happens through a capital reduction application. And it is an alternate to buyback. Buyback certainly is preferred, being a in-house process. But buyback has certain conditions. One is you can only do up to 25% of the net worth. For example, if you want to give, say in our example, you want to give 40 rupees and the net worth is 100, you cannot do. You can say I will spill over 2 years, but commercially it may not be acceptable. That what if you don't do, next year your mood changes. I don't want to wait another year for you to do the remaining amount of buyback. Buyback requires that the debt equity ratio is 2:1. So if you are highly leveraged, you are not satisfying the debt equity ratio. Third is if you do a buyback, then you are unable to issue new shares for certain time. So if you are looking at a next funding round, you would not want to do a buyback because it will restrict the issue of shares in a short-term future. So when any of these or like these issues come up on buyback, you would want to look at capital reduction. Capital reduction again involves NCLT, but is a much simpler process than a merger. You have to make sure that there is a power in your articles, there is no arrears to deposits. Here you have to pass a special resolution of the shareholders at the outset. So then everyone is consenting. And then you file to NCLT. Whereas what happens in a case of a merger or a scheme under 230, through which also you can do capital reduction, in that case, you are first doing the entire process, going to NCLT, then calling shareholders meeting. So shareholders meeting is effectively 3 months away, 3 to 4 months away. Whereas here it would happen almost in a month or so. So many times the time is critical that people don't change their mind. Right now, people have agreed to a particular structure, particular payout. Let's have their consent and move in a way that their chance of retracting is very less. Or rather, they don't have an occasion to retract. Whereas in merger, what will happen against it would be problems. There also you do safeguards by consent and all, but here it is a more statutory safeguard being there. So once you pass the resolution, you file an application to NCLT, then you'll give notices, a newspaper advertisement, and then an affidavit to tribunal of fulfilling the notices. Then if there is any objection received from anyone, and NCLT will pass the final order and you'll register the order. So here there are no two petitions being filed. Here again you need to go to RDROC, but there is no OL involved. And here the limited thing to be looked at is your valuation, so the level of scrutiny here is much less than a merger scheme. Here it is a very limited aspect of rejigging the share capital. And in those cases also, if you are redoing just your PNL and securities premium and all those balances, it is even lesser because there is no movement of money. It is just improving the books which on the face optically are having a negative balance. So non-applicability. Minority squeeze out we have spoken. In books, this is just a further elaboration of that if you have capital reserve, general reserve, CRR, all is eliminated. Equity to preference, we have also put a recent ruling where this has been allowed. Preference shares redemption, the concern we have discussed. Family arrangement, we have few precedents also where that has been done. And gives you a overarching comfort on the bona fideness and acceptance by NCLT. That there was a family arrangement, there is no transfer, there is no consideration. All those views are being blessed by NCLT, always helps in tax scrutiny rather than an internal document. Only one small additional last point before I hand over to Kathy ma'am. Now buyback, earlier buyback had a different tax regime. Now buyback and capital reduction have the same tax regime that both would be regarded as dividend. Now buyback is regarded as dividend even if you don't have accumulated profits. For example, in the preference share example, we said that 50 crore preference share, only 20 crore of profit. So if you do a buyback, hypothetically, not say redemption, but if you do a buyback, whatever you pay in buyback, assume you pay 50 crores, that is considered as dividend. It doesn't restrict to the accumulated profits. Whereas if you do a capital reduction, it is restricted to accumulated profits. So entities which don't have accumulated profits and want to do either capital reduction or buyback, capital reduction is more optimal from Indian shareholder perspective. Friends, voluntary liquidation is again a new gamut which has come in under the IBC law. I'll not. It is a very briefly. It is a process where through which the assets are distributed to shareholders. Is a new facet being used for last 2 3 years now, where you yourself go for voluntary liquidation. You appoint a liquidator. The liquidator would distribute the assets to the shareholders after paying liabilities, and after that he'll file to NCLT. So the NCLT doesn't come in picture till the time the liquidator has distributed the assets. So it is kind of an in-house process and helps with only one level of taxation and gives a cost step up to the shareholders, because income tax again exempts the company distributing assets on liquidation under 46. Only the shareholder has to pay tax and he'll get the cost to which he has paid tax. So negatives are it is a new process, limited precedents, whether you can transfer an undertaking with the liabilities or you have to discharge all the liabilities before distributing the assets is not very clear, though in one recent instance entire undertaking has also been transferred. Optical problem of this being a IBC process and to declare that company is under liquidation, and the final order takes a long time when the company is actually closed. So though as a shell, but you have to continue with the company. Friends, this is there are more and more things which one can go on, and the list will never end. It's like a tip of the iceberg, but I hope you had a good session, and thank you for a patient hearing.
Thank you so much, Abhitan sir, for such an enlightening session that we have. I'll take the questions that we have from the participants. The first question is, what are the most common challenges you see in post-merger integration, especially in aligning financial reporting and internal controls?
Uh, I would like to caveat that that is not my area of practice. But in mergers, what we tend to do is there is always a time gap between the order and the decision to merge, which is 6 to 9 months. So simultaneously, one starts aligning the processes and doesn't start when the order is received. So it's a very parallel function, which depending on the facts, if both are on SAP, it is easier. If both are on different kind of softwares, it really becomes a large one to transition. Yeah, I think so.
Okay. At what stage should the financial due diligence team ideally be involved to avoid any value leakage or last minute deal breakers?
If you ask me, there is depends on the complexity of the matter. It is easy to say earlier the better, but what happens practically is till the time they don't have reasonable certainty of the deals going through, they don't want to kickstart more cost centers. For example, right now we kickstarted tax DD FDD on a company. Then it within 2 weeks it came back that no, we'll only take over the particular asset and will not take over the company. If you are asking from company business point of view, if the debt is high, you certainly involve it faster. If it is a regulated sector or is government focused sector, infra sector, then it is needed at a much earlier phase. If it is more on the service side, tech side, could be a later stage would also be workable.
Thank you, sir. Uh, what are the so for small private limited companies, you said that fast track merger scheme is the best way to go ahead. Can you more elaborate more on the stamp duty implication on merger in case the companies are holding immovable properties?
Again, this depends on state to state. Stamp duty is a state subject, and each state has its own law. And it on mergers it varies a lot. There is no standardization. But if I have to talk about particularly Maharashtra, the stamp duty law says 10% of the value of shares issued, but which cannot be higher than 0.7% of the shares or say 5% of the immovable property. So if it is within a group realignment, what we do is we issue preference shares. You issue preference shares of say a crore or 10 lakh, whatever. Then you go into, and if the assuming there it is a crore of shares and immovable property is of 50 crores. So even 5% on 50 crores will come to 2.5 crores. Whereas if I issue 1 crore of shares, 10% of that is still 10 lakhs. So I'll pay 10 lakhs as per the formula and be out. Second alternate is to try and see if it becomes a wholly owned subsidiary.
Yeah.
Because Maharashtra is very clear that only on the shares issued you have to pay stamp duty. Whereas Karnataka provides that even on the deemed value you have to pay. So again, state to state, but looking at the clause, you have to see if you can put it as an undertaking for the one Allahabad High Court decision. Others are also there that undertaking is a movable property, and if you do a scheme for that, so can you get the movable property rate instead of the immovable property rate? Again, many times what we say technically, but what is practically acceptable by stamp duty officers on ground is very different. So always for any such positions, insistence is to understand their practice. Because if tomorrow they are not going to transfer your immovable property, nothing will work. You'll have to pay that stamp duty and you have planned on the basis that you are not supposed to pay.
Yeah. So because in the holding and subsidiary company, there will not be any issue of shares. In fact, there will be a cancellation of the investment.
Right.
How do you align valuation expectations between the buyer and seller during negotiations?
It's not, again, sorry, not my area. One is where tax comes in. We see that if the step ups are available and the money directly reaches the buyer, for example, non-compliant merger or merger with a consolidation, something on that basis. Otherwise, commercially, how both of them negotiate is not something my domain is.
In what situations would a company strategically prefer a demerger over a merger?
All see right now the flavor or the theme is sum of parts is higher than the one aggregate unit. What part can satisfy ESG? Let us do that separately. What has a different class of investor? Let's put them in a different class. Merger would be that if you are, shying from, say, a BSE 100 benchmark, so a merger will take you to BSE 100 or Nifty 50, then you would want to consolidate. If it is the same line of business and there are synergies which are available, you would again want to consolidate to look at for being the larger player in the market. For example, ACC Ambuja is consolidating, whereas Reliance is splitting Geo separately, being a different line of business, different multiples being commanded by different businesses. And also each business should have has their own life cycle where it is mature enough to be hived off in a different entity. And till the time it is in the seed stage, you keep it in your parent vehicle.
What are the typical red flags a CA should look for while conducting due diligence for a M&A transaction?
Again, the red flags really go sector by sector. It goes by what you are looking at. Are you looking at financials? You are looking at your ROC compliances. You are looking at income tax. You are looking at GST. So each area would have their own reasons. Yes, first the quality of disclosures, the first feel of the financial report tells you broadly what would be, the control be like, the experts being employed. Then now there are various softwares available which will also give you the litigation track, the company's track record, and various, detailed analysis of the company. That will also give, and then you map that your their ongoing litigation is something reasonably robust, at least ITAT and beyond, and all courts is covered. So you map that with what litigation points they are giving you. We'll understand how transparent they are. Looking at the aging, also you'll understand a lot of things, how fair the books are, how much related party transaction has happened, and how much related party transaction has been disclosed. Both will give you a good idea about it. Internal auditors, do they have, what is the robustness of their reports, and the list goes on. But these would be top of my mind on the subject.
If during any due diligence, financial due diligence, you find that the target company has contingent liabilities not shown in the notes, how would you deal with it?
One is the assessment of contingent liability. What are their papers and reasoning why it is contingent liability, or means is to be disclosed or not? You may feel it is contingent, they may feel it is remote. So first is that determination whether it is contingent or remote. Second is in your MRL, your IRL, you should ask for even a remote liability or any ongoing litigations. It has nothing to do with whether it is disclosed or not. It would be everyone's judgment call on, what is remote, what is contingent. Many times we do have to back our judgment on it is remote through a view, whether they have they documented through an expert's view that liability is remote or not. So the barometer is, were they upfront or not? Did they try to hide it with you? Being in financials, it is disclosed or not is not the barometer. Whether were they upfront with you on the subject or not is the, and then it is the merit of the case.
I have a question on the Indies. So if a company which is so if there are two companies, a division of which is getting demerged and merged into a company, the two companies are following IGAP, and the entity into which the companies will be merged is following NDS. So at what point of time the demerged entity should incorporate the NDS? I mean, will it be applicable to the companies, or at the point of takeover the
No,
merged company?
demerged company has nothing to do with Ind AS. Till the time it doesn't trigger Ind AS as per the requirement net worth or being holding subsidiary. A demerger into a company which has to follow Ind AS is not a trigger point for it to follow Ind AS. Even in the scheme, both the companies will, the demerged company and the resulting company will provide accounting treatment following their respective accounting standards, IGAP and Ind AS. And the demerged company will account based on Ind AS 103 or broadly, whether it is common control or not. The accounting will differ, but both IGAP and Ind AS will go parallel. No intermingling would be required.
So when the
And
resulting company is acquiring the two divisions, so it will account as on the date of acquisition. From that point of time, it will start adopting Ind AS of that division.
yes, certainly. So it is following Ind AS. So even the acquisition accounting would be as per Ind AS 103. And appointed date is clarified by MCA circular is the date of acquisition. So they will account, they will, if it is a not a common control, they'll do a fair value, PP allocation, record capital reserve or goodwill, capital reserve, positive or negative. Or if it is a common control, they'll also do a book value accounting and balancing will go to other equity. So would follow. So what account? Let me put it. What accounting of the seller is irrelevant for the buyer, and accounting for the buyer is irrelevant for the seller. Both will follow their own accounting standards and accordingly account for the purchase or the sale. You're on mute. Sorry. Right.
What are the practical steps professionals should follow while evaluating the valuation of a target company to avoid overpaying or underestimating risks?
Sorry. If you can repeat.
Yeah. What are the practical steps professionals should follow while evaluating the valuation of a target company to avoid overpaying or underestimating the risks?
See, if I have to talk about, one of the troubles is the ongoing litigation. Uh, Now the approach of the courts is to go more by substance than form. Are you complying with the law in substance? If you are giving a very technical way out, the courts are not listening to it. If they are with you on substance, the form will follow. But if they are not with you on substance and you argue on form, that is not working. So if you cite precedents which are 10-15 years old, which were in favor of the taxpayer, it is not at all necessary that court will be with you. So certainly, if the seller feels otherwise, the risk can be either you can look at the tax insurance has started, but it is a very uphill task and the quantums are to be significant to approach to that. You can look at putting that money in escrow, trying to expedite the litigation process if at all that's possible. But those are the risks which nowadays are posing a lot of uncertainties on any tax positions being taken. And we have seen that when we are doing, say, pre-IPO readiness or pre-sale structuring, anything which will be questioned is not advised, is not recommended, is not liked by the clients because the buyer is just putting the entire risk and discounting the price. So I'm taking that risk, not getting rewarded for the risk, and so doesn't work that way and has become unpredictable. The time frame of litigation has gone up so high, goes into a couple of decades now. If it will reach Supreme Court, so very high. Moods of the court is not that pro-assessee as it was earlier. So yeah, but sometimes also one has to be mindful that there will always be an element of uncertainty when you deal with Indian taxes. How much that is, I'll share an example. Recently, we had a GST concern around a case that in this transaction, whether the transaction will be liable to GST or not. The primary transaction we were concerned with. We went to three senior counsels. somehow, the people, they wanted it went to three senior councils. All the three said no tax, no GST. But all the three had different reasons why no GST. So the buyers and sellers, rather than getting confidence, were discouraged because they felt that, and three are not aligned. A is saying only for A reason this is no GST. I don't agree with other reasons. B is saying no B reason. I don't agree with A and C's reason. So just makes it difficult. At the end, the transaction was dropped because the exposure was seeming is very high, and one is not clear how it will go. Though everyone is saying that there is no GST.
What is the most common reason an M&A deal fails even after initial interest from both sides?
Commercial is the paramount and continuously changing market dynamics. So either buyer feels that I can get it for a lesser price, or the seller feels that I can get it for a higher price. Again, sometimes the reasons are so petty. The arbitrage or the difference is less than 10%, but it fails.
When planning a growth strategy, what is the decision matrix that companies should use to practically evaluate and choose between the four primary external options of merger, acquisition, JV, or strategic alliance? So, is there any decision metrics to follow, or that you
No,
can
it is all very curated, and it really starts with promoter's own way of working. What is he comfortable with? Is he comfortable with having the same people? If you merge with equals, then you are not the sole decision maker. It would be, like majority or a joint one. Again, in JV, it comes to a joint decision making. Thirdly, if you are acquiring, if you have the bandwidth, the cash flow, it is certainly good. You acquire, you are in the sole driving seat, but you cannot expand at a speed which you could have expanded in a merger of similar size. But depends on what would suit your personality is paramount. Then obviously sector and other considerations. But one thing which I have found as a reasonably a good value add is to have external people on your board. It can be something like, your soundboard or independent directors. You can even have your Ps and VCs to pump in money, and they guide you in your journey. Though it is a double-edged sword, but yes, one has found that the growth is much faster if you have an oversight board.
One last question. So if there is a difference between an effective date and once the order is passed by the NCLT. So, if you are, so at what point of time should we do the accounting? Like we should treat the effective date, the value as on the effective date, or the value must have changed by the time the order has come. So, at what point of time we should take which value is the question.
Accounting and income tax has to go by the appointed date, which is the effective date. So that is the very much clarified. Then what date you transition the accounting is all on your systems and your readiness. Most of the people do it once you get the NCLT order, you have 30 days to file with ROC. So you file it when you are aligned to transition. For example, in one case, the merger order was in a manner that will be received in March. We will make it effective on 1st April because I'm in retail. All my packaging, branding has to go in the new company's name. So has many factors on when you will make it exactly effective. But that readiness is something one will have to be prepared for. And for accounting and income tax, at least everything goes back to the appointed date that you bring in your books through a JV entry, through an external Excel or a complete SAP transition. is your process of transitioning?
Thank you, CA Abitan Mehta, for an insightful and practical session. Your guidance on navigating the M&A lifecycle from identifying the right opportunity to managing regulatory nuances and ensuring successful integration has provided us with actionable clarity. On behalf of the Corporate Law and Corporate Governance Committee, I extend my sincere gratitude to our speaker today, the participants, and the organizers. Thank you all for joining, and we look forward to future knowledge sharing sessions.
Thank you so much.
Ma'am, any closing remarks from your side?
Yeah, thank you so much, Abitan sir, for the insightful session. It was pleasure having you on the board. And as I ma'am said, on behalf of the Corporate Laws Committee, I would extend our sincere appreciation to our speakers and moderator and all the participants for their valuable time and contribution. Thank you for being part of today's webinar. We look forward to your participation in our forthcoming programs as well. Many thanks.
Thank you so much.
Thank you.